Welcome back to Global Money Talk live from the New York Stock Exchange. Joining us in the second half hour is Dan Ha, partner at Karani Asset Management. Now, September is traditionally a busy conference season for equities investors, which means lots of potentially market-moving information as well as insights from corporate management. And Dan, good morning. It's great to have you back. We know that September is a volatile month, but there are a lot of conferences for investors to attend. So tell us what's been happening so far this month.
Sure. Thanks for having me back. Glad to be here. Yeah, so September is traditionally a pretty busy month. Lots going on. And the big event, I would say, over the last week or so was, there were lots going on, but the Goldman Sachs Communacopia and Technology Conference is a major event. Lots of companies in the technology, media, telecommunications space were present at that conference. And I'd say the big deal presentation at that conference last week was the fireside chat with Jensen Huang of Nvidia, the founder CEO of Nvidia. That probably, arguably, ignited the rally in Nvidia's stock price that day, which was September 11th. Nvidia shares went up something like 8+%. And last week, for the entire week, Nvidia gained double digits. So what did Jensen Huang say that was so meaningful? Well, he basically put the demand concerns of Nvidia to bed during this fireside chat. There were some concerns in the market by investors questioning the ROI, the return on investment of Nvidia's systems, products. They're really quite expensive. Lots of these technology companies are investing billions and billions of dollars buying these Nvidia chips, Nvidia products. And people were wondering, well, is it all really going to be worth it? And so Jensen Huang was on stage basically giving answers that really clarified and put that concern to bed. Before I go into exactly what Jensen Huang said, I actually want to share a couple of slides on why this potential slowing of demand could be so dangerous. So if we can pull up slide 1, please. So this is the revenue growth and market cap growth rate of Cisco going back to the late 90s and the early 2000s. What you see in the green section of the table is how quickly the revenue's been growing in 1995 through 2000. And you can see that the market cap growth in response to that was really, really strong. But following 2000, when the market started to realize that the growth rate going forward is not going to be as dramatic, as strong, you can see what happened to the value of the Cisco stock. 18% growth in 2001 for Cisco. Some might argue, well, that's not a bad growth rate, but when that slows, when you get 18% after growing 55, 44, 31% in prior years, that expectation gets baked into the stock. And when you're not delivering on that kind of growth, you could really see the stock price collapse. If we pull up slide number 3, please. So slide number 3 looks at the revenue growth and market cap growth rates of Zoom and DocuSign just after the COVID-19 pandemic, and what happened to their stock once the growth rate really came to a screeching halt. There were a lot of pent-up demand for these products, and the company grew rapidly, and so did the stock price. So did the stock prices of those companies. But once the world realized that, hey, actually, all of those who needed to buy have bought, and therefore there's not going to be growth going forward. It's going to be much more muted. That's when stock price really collapsed. So there's a similar level, kinds of concern for Nvidia because it's growing so rapidly. What if it comes to a screeching halt? What if that growth comes to a screeching halt? Then that would be really bad for Nvidia stock price. We can take the slides down. what Jensen Huang basically said on stage was, first of all, their highly anticipated product, Blackwell, is on track to start shipment in Q4, which was a good confirmation for the market. But what I thought was really interesting that he pointed out was, he said that for every $1 spent buying Nvidia products by the cloud service providers, so the Microsoft Azure, Amazon AWS, Google GCPs of the world, for every $1 spent, they're actually getting about $5 of rental revenue. So they're buying Nvidia systems and renting out that compute capacity to the customers. And right now, the demand is really still super high. And this is a clear, you spend $1, you get $5. It's pretty good math. So when you have that kind of unit economics, if you will, it indicates that the demand isn't going to be slowing anytime soon. And just in terms of in terms of demand, GPUs are associated with AI right now. AI is the buzzword, obviously. But there is a big need for all the legacy data center infrastructure, which is based on the CPU technology. That needs to convert to GPU technology, the accelerated computing technology, eventually, because Moore's law which really drove compute advancement over the last several decades, is widely expected to come to an end, and the world needs to figure out a new way to advance compute. And right now, it seems like the only answer to that is accelerated computing, which is what Nvidia powers.
And Dan, I think it was so helpful for you to bring up the chart of Cisco as well as DocuSign and Zoom, because when we think about those two latter names during the pandemic, we know the role that they played when work from home had been a big part of employees' lives in corporations. And the example of Cisco, what we saw in the late 90s as opposed to the 2000s, and what happened in terms of their revenue growth and what happened to market cap, because we know when Nvidia came out with their earnings at the end of last month, we saw maximum growth, but not good enough and not as good as expected in terms of Wall Street estimates, and that affected the share price. So that is very interesting to keep in mind, because when we're looking at those growth numbers, if that had happened to any other company that is listed, that is substantial, isn't it?
Right. No, and that's a great point. I mean, the parallel with, I'm not suggesting that Nvidia is the next Cisco or Zoom or DocuSign. What I'm trying to point out, though, is that if you actually listen to a lot of these tech company leaders on the need to invest in Gen AI capabilities, which means investing in the infrastructure, which means buying lots and lots of Nvidia chips to the tune of billions and billions of dollars. What you're actually hearing is, when you're asked about the ROI on these investments, a lot of these leaders will tell you that, well, we don't really know what the ROI is or is going to be exactly, but they're investing right now because they can't afford not to, which is good but also worrisome. It's good in a sense that basically the customers of Nvidia are really buying without asking questions in a way, but it's worrisome because what happened with companies like Zoom and DocuSign was companies were buying Zoom licenses left and right. I mean, back in 2000, at large companies, you almost didn't even have to get permission to buy these licenses, because people needed them now, and companies said, okay, go ahead and buy. We'll ask questions later. But eventually they started asking questions. Do we really need all these licenses? Don't we have Microsoft Teams? So the thing about all these tech companies investing in Nvidia chips now is they have to get in line right now, because there's just such limited supply. But it could be worrisome because, if the ROI really isn't there, at some point they're going to start wondering, wait, we bought all this we bought all these chips. Do we really need to buy any more? And it was similar in the .com during the .com period.
Yeah.
After once everyone had their equipment, once all the equipment was installed, then suddenly the world realized that, you know what, we actually don't need to buy all of this anymore, or to the scale that we were purchasing. So that would be the concern if something like that were to happen. What I am trying to say, though, is that Jensen Huang, at least for now, last week, seems to have put that worry to bed.
And of course, we'll have to keep an eye on Nvidia prices as we head into the rest of the quarter. But I'm glad you brought up Moore's Law, because some are questioning whether or not in this age in 2024 that still has more room to go. So yeah, it has been nearly 60 decades since Gordon Moore came up with this, and it's hard to believe it's been that long, but of course a lot of technology has changed since then, so something to consider. Right,
yes. I mean, Moore's Law, for those who may not be familiar with it, it's really more of an observation and a prediction than law. But Gordon Moore, the co-founder of Intel, came up with it, hence the name Moore's Law. But it's the observation and prediction that every 1.5 to 2 years, the number of transistors on a chip will double without a significant change in the cost. So what that means is, basically, to put it very simply, every 1.5 to 2 years, the latest computer 2 years from now will be twice as fast, will have twice as better performance than the latest computer today, without much change in the price of that computer. So I think we could all probably remember the time, when our computers were just getting really old and really slow really quickly.
Yeah.
Well, that's because computers were just getting that much better so quickly. But it is a widely held view, although it's not universal. It is a widely held view that Moore's Law will come to an end fairly soon, because there's just simply physical limitations on how many transistors you could fit in that tiny little chip. Right now, the most advanced chips literally pack tens of billions, in some cases 100+ billion transistors in that tiny little chip. At some point, you're gonna run out of space. So the world needs to figure out a way to continue to advance compute, and it is generally, I think it's widely held view that accelerated computing, which is what Nvidia provides through its GPUs, is the answer to the end of Moore's Law.
And before we move away from this subject, I do want to ask you about what Jensen Huang also said. So can you give us a little bit more insight before we move on?
Sure. No, there were lots of really insightful comments that Jensen Huang made in that fireside chat. One of the things that stood out to me the most was Nvidia's competitive moat. So he was asked to comment on Nvidia's competitive moat, and he said that it's really their software capability that's going to be their moat going forward. Nvidia is, a lot of us know that Nvidia sells hardware. The product that they sell, the product that they physically deliver, is a very large computer, essentially. But it's really their software that differentiates Nvidia. So Jensen Huang talked about how protecting the software investments of the software developers and their customers was important for the company since day one. And whenever they develop products, they want to make sure that the next product that they launch is going to be compatible with the software investments that the customers or the users of Nvidia products have made, so that the software product is not obsolete when the new version of the hardware comes out. And if you think about that, if they could continue on that trajectory, if they can continue to pursue that strategy, at some point they will have a very large installed base, which will operate off of the same software. It's actually quite similar to, if you think about Apple and the iPhone. So it was pretty common for people to be upgrading their iPhones once every 2 years. Some people did it every year. There were new, iPhone 3 or 4, and then there were iPhone S, and then iPhone 5, and then iPhone 5S, and iPhone 6. And it was common for people to always want to have the new phone because the hardware was just advancing. The hardware was getting better and better with every generation. Apple will argue that even now the hardware is getting better and better with every generation, but the differentiation is, I think most people will agree, that it's becoming less and less and less. However, even though the hardware cycle has lengthened, what Apple now has is a very large installed base that is using their software, and therefore they're able to collect services revenue. The ecosystem, the app ecosystem, the software ecosystem is that much stronger. So Nvidia right now is launching a new product basically every year. And the performance of the new product versus the previous product is really wide, almost night and day. But that can't continue forever, right? At some point, that product cycle will have to lengthen. But by then, it's possible that Nvidia will have a really large installed base that they can then monetize in other ways using software. Just one other thing, a couple of other things I want to mention about that is Jensen Huang also talked about, sort of reminded us that Nvidia's products are really at this point they're not just selling you chips, they're really selling you systems. So Blackwell, their latest product, is a system with 7 different chips. So it's not like if you want to have Nvidia's performance without buying Nvidia's products. It's not like you can just go out and buy 7 GPUs on your own and put them together and expect them to perform like an Nvidia product. It's really, Nvidia is selling you a complete system, and that's something that sort of further differentiates the company and deepens the moat of Nvidia.
And Dan, I think those are good examples. So building on what you just said about Nvidia and also Apple, because we think back to when the iPhones first came out and how upgrades used to be common, but we also have to keep in mind that the cost was cheaper back then as well.
Right.
And now we're awaiting the latest OS for the Apple iPhone. But building on what you just said, when we're talking about companies such as Nvidia or Apple, the supply chain comes into play as well.
Yeah.
And especially in a US presidential election year, we're hearing about how that matters to Americans since we're here in the US.
Yeah.
But give us a little insight into the supply chain.
Sure. No, yeah, and Jensen Huang also addressed the supply chain concern, which is obviously top of mind for a lot of people, just given the geopolitical environment. I mean, he did say that, and I'll take his word for it, he did say that Nvidia has enough IP around production and manufacturing within the company to be able to, if for whatever reason, if they can't produce in Taiwan, that they can shift that production to other fabs.
Okay.
So that obviously they're obviously thinking about it. I'd be shocked if they weren't thinking about it, just given how important supply chain is to that industry. But at the same time, something like that, hopefully we'll never have to test it. But something like that, the world will just have to find out if it's really if it would be as effective as the current supply chain. Again, hopefully the world will never have to find out. But and I'm sure by going to other fabs that they'll be able to produce. Like I said, I'm taking Jensen Huang's word for it. But it may come with a much bigger delay in delivery times, for example. So it's too hard to know. But they're obviously thinking about it.
And I do agree with you there, especially when it comes to planning for contingencies as well as risk management. Hopefully we don't have to find out, but if that does happen, it is also helpful to know what plans are in place.
Sure, yep.
And very quickly, let's do a quick market check live from the New York Stock Exchange. So in New York morning trade, we are seeing the major stock averages hold on to session gains. The Dow Jones Industrial Average up over 0.25% or up triple digits, up 113 points right now. The Nasdaq Composite Index is also extending gains in New York morning trade, up by 0.7% or over 120 points. And the S&P 500 right now is up nearly 0.4%. Holding around the 56-54 level. And of course, now shifting our focus to AI as well as technology, it is no secret that it is becoming capital intensive, isn't it? So
Sure.
tell us what you expect to see in the near term.
Yeah, that's very interesting. Technology industry, which is traditionally a fairly capital light industry, is becoming more and more capital intensive. And more specifically, that's around the companies that are making these large infrastructure investments for generative AI capabilities. If we could actually pull up slide number 4. Slide number 4 will show you that. Slide number 4 shows us the scale of these investments that these large tech companies are expected to make going forward. We're really talking collectively in the hundreds of billions of dollars. Larry Ellison, the founder of Oracle, the other day mentioned that today it would cost somebody $100 billion to start competing with the frontier models, frontier AI models, meaning the most cutting edge AI models. So you really need a lot of money to enter this market and compete with the big guys, if you will. If we actually pull up slide number 5, it'll give you some sense as to how capital intensive, capital intensity that we're talking about. So the top 4 investors in AI infrastructure, so that's Amazon, Microsoft, Google, and Meta, is expected to invest about $200 billion in this year to get themselves ready for the coming age of AI. That is more than the other 90 companies in the technology and communications sector combined. It also rivals the level of investments, capital investments, that the big oil companies made at their peak in 2013. So we're really talking about large amounts of money. And this is perhaps also why I've read an article, and it's more anecdotal for now, and we'll have to see if this actually plays out. But read an article about how the AI talent is actually flocking back to the larger company, the more established players, because especially at the infrastructure layer, it's too hard for a startup to really penetrate that market, just given the increased capital intensity of AI. Now, what's interesting about this is historically increasing CapEx, increasing capital investments, is not good for stocks, generally speaking and historically speaking. What's interesting about the mega cap tech companies today is that they actually may be in a sweet spot of capital intensity, capital intensity working as a barrier to entry for the newcomers, but also not crippling the profitability of these companies. We know that the largest tech companies are extremely profitable. They're also sitting on lots and lots of cash. So the investments that they're making, while very large in size, in absolute size, probably won't be enough to really cripple the profitability, structurally cripple the profitability of these tech companies going forward. Just to give you a little bit of sense, roughly $200 billion is about 40% of the collective EBITDA of these 4 companies. Back in 2013, about 175 billion of collective capital investments that the big oil companies made represented almost 80% of their EBITDA. So while the dollars are similar, the relative intensity of these investments is much lighter for the largest technology companies.
I think it's really helpful for the viewing audience to get this comparison of what we're seeing right now unfold for the big companies, particularly within the Mag 7 names, and compare it to other industries and what we've seen in the past.
Sure.
And I think it's also interesting to hear about the talent in terms of moving back to the bigger companies, because when there's an emergence of a new gold rush into a certain sector of tech and seeing how they are moving away from potential startups or moving back to the big names, I think that is indicative of what we're seeing in the landscape.
Right, right. And just to be clear, right now it's more anecdotal. So we'll have to see, like I said, we'll have to see how that actually plays out. It is natural, naturally in a new area, it's usually those that leave the established players and go join a startup that tend to lead the way. But in this particular case, because of so much capital required, especially in the infrastructure side of AI, that it actually it probably will be very difficult for a startup to try to crack that part of the value chain. On the application layer, though, of AI, I'm sure there will be plenty of very interesting companies, startups, that will use the infrastructure to come up with new use cases that adds value to the end users.
And before we move on, I do want to ask you about the profitability of tech companies. Do you expect this to continue?
Sure. So tech companies, by and large, are so profitable because technology, especially software, has tended to be a winner-take-all kind of business. What's interesting about that dynamic is software is a digital product, meaning it is distributed digitally. There's no real physical barrier to distributing a digital product. When you're selling widgets, there is a physical limit as to how far you can reach. If I'm buying widgets, sometimes or often I have to settle with what is like the best available to me in my local area. So an example is, I could want the highest quality Swiss chocolate, but if my local store doesn't carry it, and let's assume for a moment that this is time before e-commerce, but if I need it, if I want Swiss chocolate, but if my local grocery only sells Snickers and M&Ms, well, I kind of have to settle. I have to settle with that because that's the best available to me.
Okay.
But a digital product, which is delivered digitally, has no such physical barrier. So if I want to use a piece of software to run my company, the number 1 product and the number 2 product and the number 3 product are all just a couple of clicks away. So there's very little incentive for me to use the number 2 or number 3 product, because why? Unless there's, even if there is a material cost difference, if the number 1 product is truly number 1 and is the best, I'll just use that. And that product is available to everybody, essentially everybody at the same time. So that winner-take-all nature of software is what has caused these largest technology companies to operate at such huge scales, and that's what's driven the profitability of these companies. I don't personally see how that changes going forward. The only way that changes is if some external force forces these companies to these operations to break up, which could happen, and which is why there is perhaps so much attention being placed on what the government might do to break up these companies. But government might be able to break up the existing companies, but I don't see how that necessarily changes this winner-take-all, digitally distributed digital product dynamic, the nature of software products.
And Dan, I think it's very helpful to provide that example of widgets in comparison with Swiss chocolate before the day and age of e-commerce. So very quickly, before I let you go, tell us about positioning.
Sure. So I've said lots of exciting things about AI and Nvidia and such, but I'd be remiss not to mention some of the risks in the risk-reward equation. There's obviously risk with Nvidia and with any investments for that matter. And when it comes to Nvidia, investors just have to be mindful that there are lots of high expectations already built into the stock. So for a company like Nvidia, it's something that I think I would personally, it's something, for full disclosure, we own some Nvidia at my firm, and it's something that I want to own because it could potentially be the most important company over the next decade as this AI revolution unfolds. Do you want to sit out on that? Probably not. So you probably do want to be involved. At the same time, just given such high expectations, do you want to be, would I make it a huge position, a huge portion of my portfolio in Nvidia or just one AI stock? Probably not. Every investor has to make that decision for themselves in the context of their overall portfolio. But you do want to maintain balance just because of such high expectations.
Okay, Dan. Well, we're out of time, so thank you so much for joining me, and thank you for sharing all of your insights today.
You're welcome.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you for joining us, and we'll see you back here bright and early tomorrow. Have a great day.